Most traders who come to scalping come to it for the wrong reason. They come because they think faster means more. More trades, more opportunities, more money. They come because holding a position overnight makes them anxious and scalping feels like control. They come because they blew up on swing trades and figure shorter time frames mean shorter exposure means smaller mistake. And then they discover something nobody warned them about. Scalping doesn't reduce the psychological pressure of trading. It concentrates it. Every flaw you have as a trader, every emotional reaction, every moment of impatience, every tendency to revenge trade or close too early or hold too long, scalping surfaces all of it faster and more brutally than any other style of trading. Scalping doesn't simplify trading. It amplifies you. Which means if you come to it undisciplined, it will break you quickly. But if you come to it with the right framework, with rules you actually follow rather than rules you write down and ignore, it becomes one of the cleanest, most executable styles of trading there is. These are the 10 rules that separate scalpers who last from scalpers who blow up. Not theory. Not textbook advice. The rules that actually matter when price is moving fast and your finger is hovering over the button. The first rule is trade the session, not the clock. Most new scalpers sit down and decide they're going to trade for 2 hours. They block out the time, they open the platform, and they look for trades regardless of what the market is actually doing during those 2 hours. That is the wrong way to approach it. Scalping only works in conditions that support scalping. You need volatility. You need volume. You need price to be moving with conviction rather than drifting sideways in a low liquidity chop fest. Those conditions exist during specific windows. The open of major sessions, the overlap between sessions, the hour around major news releases, and they do not exist for the rest of the day. The rule is simple. Define your session window based on when your market actually moves. Not when you feel like trading. When the market actually provides the conditions your strategy needs. Outside of that window, the platform is closed. You are not a trader waiting for something to happen. You are someone doing something else entirely. The traders who scalp randomly throughout the day accumulate losses in the dead hours that eat everything they made during the live ones. The second rule is one setup, mastered completely. Scalping attracts people who love complexity. Fast charts, multiple indicators, signals everywhere. And because price moves quickly, there's always something happening that looks like a reason to enter. The result is a trader who knows 15 setups moderately well and executes none of them with any real edge. Pick one setup. 1. The cleanest, most repeatable pattern your market produces during your session window. Learn it until you can see it forming before it's fully formed. Know exactly what needs to be present for it to qualify and exactly what disqualifies it. Know where you enter, where the stop goes, and where you take profit before you're ever in the trade. One setup, executed 100 times with precision, will make you more money than 10 setups executed 100 times with confusion. Complexity is not an edge. Clarity is. The third rule is define your risk before the session, not during it. This sounds obvious. It is almost never done properly. Before you open the platform, you know your maximum risk per trade. You know your maximum loss for the session. You know your maximum number of trades. Those numbers are decided when you are calm, logical, and not yet stimulated by a moving market. The moment you are in front of live price, every decision you make is influenced by what's happening on screen. That is not the moment to be deciding how much you're willing to lose. That decision needs to already be made. Write it down before you start. Not in your head. On paper or on screen, somewhere visible. And treat those numbers as fixed. Not guidelines. Not starting points for negotiation. Fixed. The fourth rule is if you miss the entry, you miss the trade. Scalping entries are specific. The setup has a window, a zone where the entry makes sense relative to the structure and the risk. If price moves through that zone while you were hesitating, the trade is gone. You do not chase it. Chasing entries in scalping is one of the fastest ways to accumulate losses. You enter late, your stop is in the wrong place, your risk-reward is broken before the trade even starts, and price is already extended in your direction, which means the likely next move is a pullback that stops you out. The missed trade feels painful. Watching price run without you feels like leaving money behind. But the discipline of letting missed entries go is what keeps your risk structure intact. There will be another setup. There is always another setup. Missing a trade costs you nothing. Chasing a trade costs you real money and real psychological damage. The fifth rule is cut losses immediately, without discussion. In scalping, speed is everything, including the speed at which you exit bad trade. When a scalp goes wrong, it usually goes wrong fast. Price moves against you with conviction, the setup invalidates, and every second you spend waiting for a recovery is a second the loss is growing. There is no negotiation with a bad scalp. No waiting to see. No hoping for a wick back through your entry. When the trade is wrong, when price has moved to your stop level, or when the structure that justified the entry has clearly broken, you close it. Immediately. Without thinking about it. The traders who can do this, who have trained themselves to cut cleanly and without hesitation, preserve their capital for the next setup. The traders who hold and hope burn through their session limit on one trade and spend the rest of the day trying to recover from a loss that should have been a fraction of what it became. The sixth rule is profit targets are not suggestions. The opposite problem of holding losers too long is holding winners too long. And in scalping, where moves are measured in small increments, giving back profit by holding past your target is one of the most common and most damaging mistakes. You define your profit target before the trade. That target is based on the structure of the market. The next significant level, the measured move, the area where you expect resistance or support to appear. When price reaches that target, you take the profit. You do not start imagining a larger move. You do not hold because momentum looks strong. You take what the setup offered and you close. Greed in scalping is particularly insidious because it creeps in exactly when you're winning. The trade is at your target and the voice says, "It's moving, let it run." Sometimes that voice is right. More often it costs you the profit you already had and turns a win into break-even or a loss. Define the target. Take the target. Move on. The seventh rule is 3 consecutive losses means the session is over. Not a guideline. A rule with no exceptions. 3 losses in a row is a signal. It might be a signal that market conditions have changed and your setup is no longer working in the current environment. It might be a signal that your psychology is off and you're not executing cleanly. It might just be normal variance. It doesn't matter which one it is. The response is the same. You stop. Because what happens after 3 consecutive losses, if you keep going, is almost never good. Your brain has shifted into recovery mode. You are no longer looking for clean setup. You are looking for a trade that will erase the losses. That is a completely different and much more dangerous mental state to be trading from. 3 losses and you close the platform. You do not come back later that session to try again. You do not tell yourself conditions will improve. You accept that today was a 3-loss day and you come back tomorrow with a clean slate. Protecting yourself from the 4th, 5th, and 6th loss is worth more than anything you might have made if the 4th trade had worked. The 8th rule is your best trades will feel boring. This is the one that surprises most new scalpers. They expect the best trades to feel exciting. The perfect confluence, the stars aligning, the rush of a clean entry into a fast-moving market. The reality is the opposite. The best scalping trades feel almost automatic. You see the setup. It qualifies. You enter. Everything unfolds the way it was supposed to. You close at the target. You move on. There is very little emotion in a well-executed scalp. Not because you've suppressed your emotions but because the setup is so clearly valid that there's nothing to be anxious about. The work was done before the entry. The decision was made before price got there. You're just executing what you already decided. The trades that feel exciting, the ones where your heart rate goes up, where you're not quite sure but you jump in anyway, where you're riding momentum without a real plan, those are the dangerous ones. Excitement in scalping is usually a signal that something about the trade doesn't fully qualify and your brain is compensating with adrenaline. When a trade feels boring, that's a good sign. When it feels exciting, be careful. The 9th rule is review every session the same day. Scalping generates a lot of trades relative to other styles, and each trade carries information about market conditions, about your execution, about where your psychology held and where it didn't. That information expires quickly. The emotional memory of why you made a decision fades within hours. By the next morning you'll have rationalized most of it or forgotten the details entirely. Review your session while it's still fresh. Go through every trade. Not to judge yourself but to understand yourself. Which entries were clean and which were forced. Which exits were disciplined and which were emotional. Where you followed the rules and where you bent them. What the market was actually doing versus what you thought it was doing. This review, done consistently, done honestly, is where your real development as a scalper happens. Not in the trades themselves. In the pattern recognition that only comes from regularly examining your own behavior. The 10th rule is protect tomorrow. This is the rule that holds all the others together. Every decision you make in a scalping session should be filtered through one question. If I do this, will I still be able to trade well tomorrow? Going over your loss limit today costs you tomorrow. Revenge trading after a bad session costs you tomorrow. Holding a losing trade past where it should have been cut, hoping for a recovery that never comes, costs you tomorrow. Staying at the screen an hour past when your focus gave out, grinding through bad conditions trying to end the day green. That costs you tomorrow. The session you're in right now is not the only session that matters. Scalping is a cumulative game. Consistency over weeks and months and years. And the traders who build something real from scalping are the ones who treat every session not as an isolated event but as one episode in a very long series. Protect the series. Protect your capital, your psychology, your discipline, your ability to come back tomorrow and execute cleanly. None of those things are guaranteed if you burn through them today. The market will give you another session tomorrow. The only question is whether you'll be in a fit state to trade it. Scalping rewards precision, not aggression. Patience, not speed. Discipline, not frequency. The traders who understand that from the beginning save themselves years of painful lessons. The traders who don't, who come to scalping believing it's just faster trading, eventually discover that the market is a very efficient teacher. It will charge you for every rule you ignore. And in scalping, the tuition arrives quickly. Follow the rules. Protect tomorrow. The results take care of themselves.